Chicago currently faces a massive backlog of highly ambitious real estate and sports development proposals, all demanding public infrastructure support at the exact same time. The Chicago Bears are pushing for a completely new domed stadium on the lakefront. Simultaneously, the White Sox want to build a ballpark at a dormant South Loop parcel known as the 78, and the owners of the Bulls and Blackhawks are proposing a sprawling mixed-use campus around the United Center called the 1901 Project. This animated bar chart shows the total scope of these combined proposals, which currently sit at $11.1 billion. Subtracting the private capital the teams are willing to contribute leaves the city and state facing an $8.8 billion infrastructure deficit. The traditional method of bridging this gap is dead on arrival. Governor J.B. Pritzker has made his mandate clear. New public subsidies and new general taxes to fund private sports franchises are absolute non-starters in the current political climate. Ownership groups are actively leveraging this gridlock. Both the Bears and the White Sox have engaged in highly publicized flirtations with neighboring municipalities and even across state lines into Indiana, threatening to abandon the city entirely if their stadium demands are not met. The municipal playbook of taxing the public to fund private sports franchises is mathematically and politically dead. State lawmakers require a completely new mechanism to finance these projects without levying taxes. A private consultancy firm called PSC Chicago has proposed an alternative structure to break the stalemate: the creation of the Great Lakes Development Authority, or GLDA. The core mechanical innovation of the GLDA relies on statutory consolidation. Rather than inventing new taxes, the state would physically merge the legal and financial structures of several existing public agencies into a single, massive governing body. The benchmark for this model is the Port Authority of New York and New Jersey. For over a century, the Port Authority has successfully self-funded massive cross-state infrastructure projects. It achieves this by pooling the revenues of diverse, high-earning assets, like airports, seaports, toll bridges, and tunnels, into one central financial reserve. PSC Chicago argues that Illinois can replicate this exact model by combining its currently chaotic and fractured system of local transit boards, tollway authorities, and convention management groups. To build these stadiums, lawmakers must re-engineer how the state governs and leverages its existing infrastructure. This topology map shows the organizational structure of the region's public transportation. Recently, lawmakers created the Northern Illinois Transit Authority, or NITA. This agency consolidates local systems like the Chicago Transit Authority, Metra Commuter Rail, and Pace buses. Despite the reorganization, NITA operates on a high-deficit model and faces a fiscal cliff of nearly $1 billion. Conversely, the Illinois Tollway operates with a massive, highly predictable surplus. In a single year, the tollway can generate hundreds of millions of dollars in unrestricted cash reserves. Further isolating the state's capital are the authorities running tourism and sports. The Metropolitan Pier and Exposition Authority, or MPEA, controls the lucrative convention centers, while the Illinois Sports Facilities Authority, or ISFA, manages existing stadium debt. Strict statutory walls currently govern these organizations. By law, the tollway's massive cash surplus cannot be used to bail out the starving transit system, nor can it be deployed to fund new development projects outside of its immediate highway jurisdiction. Fragmented governance artificially impoverishes the state, trapping billions of dollars of liquid capital in isolated accounts, while critical infrastructure projects run deficits. The PSC Chicago proposal executes a precise legislative maneuver: a legal merger absorbing the newly created Transit Authority, the convention authorities, and the tollway directly into the Great Lakes Development Authority. This Sankey diagram illustrates how specific existing taxes are redirected under this plan. Motor fuel taxes, the existing Regional Transportation Authority sales tax, tollway cash, and convention revenues are all routed away from their isolated agencies and funneled into a single unified pool. The resulting consolidated entity controls an annual operating revenue exceeding $7 billion. In municipal finance, predictable, diversified cash flow is the ultimate asset. When lenders see revenues from highways, trains, and convention centers backed by a single state authority, that massive cash flow functions as ironclad collateral. Backed by this massive collateral pool, the GLDA gains the capacity to issue private bonds on the open market. This allows them to borrow enough capital upfront to cover the entire $8.8 billion stadium and infrastructure gap. By tearing down administrative walls, the state mathematically transforms its existing operating revenues into billions of dollars of bondable collateral, entirely avoiding the need to levy a single new general tax. In the GLDA framework, the stadiums act as a financial flywheel. The massive guaranteed ridership from these venues acts as the catalyst required to justify deep investments in regional transit. This transit investment directly addresses spatial mismatch, a macroeconomic term describing the physical and infrastructural barriers that isolate the labor pool on Chicago's South Side from the intense economic activity and job markets of the downtown core. The primary physical bottleneck causing this disconnect is the St. Charles Airline, an antiquated, narrow rail corridor near downtown that forces commuter trains to share space with slow-moving freight. The GLDA plan allocates $600 million to upgrade the airline, providing the necessary clearance for the Metra electric line to reach the city core. Bypassing the freight bottleneck creates a high-speed, direct one-seat ride. Commuters from historically disconnected South Side neighborhoods would finally have uninterrupted, rapid transit straight into Union Station. To pay for $3.8 billion in rail and concourse upgrades, lenders require proof of consistent future revenue. The millions of fans traveling to the new Renaissance campus stadiums provide that exact economic justification. The stadiums are no longer billionaire handouts. They are the required economic engines to physically bridge Chicago's historic geographic inequalities. The most ambitious expansion of the authority involves absorbing the Chicago Department of Aviation directly into the GLDA portfolio. Bringing O'Hare and Midway airports under the control of the superagency adds massive international passenger fees, federal grants, and vendor revenues to the capital stack. Airport integration allows the GLDA to coordinate a seamless logistical pipe. Travelers landing at O'Hare would step onto express rail lines managed by the exact same authority, taking them directly to the doors of the Renaissance campus. Managing the airports establishes the GLDA as a continental-scale logistical empire with direct control over international transit and trade. This level of control allows Illinois to directly counter aggressive political threats. Recently, Indiana lawmakers pushed legislation to build a stadium in Hammond, actively attempting to poach the Chicago Bears across state lines. The GLDA's strategic countermeasure is to physically absorb Indiana's commuter rail, the South Shore Line, into the Chicago Mega Authority. By integrating the South Shore Line, the GLDA captures the daily commuter fare box revenue generated by Indiana residents, adding those millions directly into the Illinois capital stack. If the GLDA controls the South Shore Line, it controls the only viable transit access to the proposed Hammond Stadium site. By governing the physical infrastructure required to reach the stadium, Illinois effectively neutralizes Indiana's leverage. The final rail maneuver involves taking over the state-supported Amtrak Midwest Michigan line. The GLDA offers a clear arrangement. By moving passenger trains off heavily congested freight lines and onto dedicated tracks, the authority creates a true high-speed corridor connecting Chicago directly to Detroit. The GLDA weaponizes infrastructure planning to end interstate border wars, absorbing regional competitors and utilizing their transit revenues to fund Illinois projects. Planners compare the sheer scale of this consolidation to Daniel Burnham's historic 1909 Plan of Chicago, an architectural vision that completely reorganized the city's lakefront. If fully enacted, this regional state entity would command an $11.8 billion revenue stack spanning 3 states, managing a combined workforce of 22,500 employees. Executing this requires extreme political friction. The mayor of Chicago would have to legally surrender control of the city's airports, and the governor would be forced to navigate an incredibly complex multi-union labor merger. The region faces a strict binary choice: accept the intense political pain required to consolidate these agencies, or watch the megaprojects collapse under the mathematical weight of an $8.8 billion deficit. Chicago must choose whether to protect the fragmented political fiefdoms of its past or engineer the $7 billion superagency required to finance its future.